All right, folks, we've got a very big show today. We are going to talk about the topic that is the single biggest barrier for first homeowners who want to get onto the property ladder. And of course, Ben, I am talking about the deposit. We're going to tackle that today when we've got some very special guests to help us do that. First one is Julia Hartman, who's found a very clever and unique way to use the vehicle of superannuation to save up the deposit for your first home. But who else have we got on, Ben?
Bryce, technology, prop tech. I'm going to double click on two interesting ideas in saving for a deposit or bypassing the ability to save for a deposit. So if I mention something like Our Leg Up or OwnHome, you're going to learn a lot more about them when we interview the two founders of those two different businesses.
Folks, you got to stick around. This is an episode you do not want to miss. If you're struggling for a deposit or you know someone who needs to know about this is the episode for you. Let's rip into the show.
Welcome to the Property Couch, where each week you get to listen to two of Australia's leading experts. Bryce Holdaway, co-host of Location Australia on Foxtel's Lifestyle Channel, co-host of Escape from the City on the ABC, and partner of Empower Wealth Advisory. Ben Kingsley, chair of Property Investors Council of Australia and the founder of Empower Wealth Advisory, named the 2018 and 2019 Property Advisory Firm of the Year. Stay tuned as they bring you the insider's guide to property, finance and money management.
All right, mate, welcome back to another episode of the podcast. This is my favourite time of the week, hanging out with you, mate. How are you?
Big show, Bryce. Big show. But firstly, I just got to say, Pies, girls, gave your best. They didn't get through. Crows got the job done. Good luck to the Crows and the rest of the teams in the girls' AFL. It's obviously getting to the serious end now, prelim finals next week, and then obviously the big dance after that. But we bow out, unfortunately. So
Couldn't
well
happen
done,
to a better club, Ben. Couldn't happen to a better club.
Love it. Yeah, very nice.
Hey, we do have a big show today. It is our opportunity to. The title is called "Make Home Deposit." I can't even remember it myself, Ben, but Home Deposits Made Simple.
Yeah.
And we've got a unique way to do that. There's government schemes, there's equity programs, there's unique and innovative ways to try and get people on the property ladder. So we understand that the divide between the wealthy and the not wealthy in this country usually is on a foundation of home ownership.
It is.
So this is our contribution to, in this present time, seeing if we can help more people get home ownership. Now, we're doing it in a couple of ways. We've actually got three contributors, Ben, besides you and I. The bulk of it is with Julia Hartman, who's a returning guest, which we'll get to shortly. But we've also found two innovative solutions in the marketplace that people can consider that might help them on. And I think as an important footnote, as you listen to this episode, Ben, the activities that we're going to present, there is no commercial relationship with us. Property Couch, our business, it is just some good people in the marketplace looking for a creative way to get people on the property ladder, and we're going to showcase a couple of those in a little bit. So a bit to cover today, Ben.
Yeah, it's a really important show, Bryce, because ultimately, as you were saying before, it's all about, transforming people's belief that it's possible to actually get into the property market in this country. Mm-hmm. I know that can feel a little bit overwhelming, and certainly the data suggests that, the deposit is the biggest barrier. So we'll continue to shine a light on and continue to, live in hope, and, through hope and action, people can create that lifestyle by design and get their foot in on the property ladder. And that's what today's show is about.
Very good. My Mindset Minute theme today, Ben, is most people avoid learning new skills, not because they're lazy, but because they hate feeling stupid. All right, that's setting up the Mindset Minute. So we typically choose to do things that increase our status and sort of in mental brackets of intelligence, and avoid the things that decrease our status of us feeling silly, right? So you and I have been riffing about this over the last week, and I just wanted to see if I could bring it in today to share it with the community. But this concept that ultimately people experience FOMU way more than they experience FOMO. And FOMO of course, Ben, is easier to say in your head than it is to say in real life, is the fear of messing up.
Yep.
Let that land, folks. Do you have the fear of messing up? Have you ever had FOMU? So I think that this is generally the number one reason why most people don't have financial peace, Ben, because FOMO keeps more people from action than FOMU keeps more people from action. Hang in with me, folks. Just lean in on this. This is important. Even though I can't speak today, it is important. FOMU keeps more people from action than price. Let that land. FOMU keeps more people from action than price. But action is the common denominator between most successful people, right? So if FOMU is getting in the way and action is what we need to do, this is something we need to overcome. So breaking it down to what is the next step that I need to take and then take it. Here's the important part about that. Your view will get clearer from there. So now here's the point, Ben. Did any of that make sense? Because it made sense in my mind when I was setting that up. Right?
Yeah, no, look, I actually, when I saw what you'd written down here, I think, and this is, people should go back and try and re-listen to that, because it's effectively what we're talking about here is breaking the status quo and the indecision. And the idea behind that is that if you do that from a property point of view, that the squeeze is worth the juice, as opposed to the other way around. Like some things in life, the squeeze isn't worth the juice, right? Where it's just too much effort and so forth, so the status quo can hold that. And we all want perfect knowledge, but the fact of the matter is we can't achieve perfect knowledge. So the conversations that you and I have been having is about how do people, why do people fall into that indecision category? Well, it's really simple. And that is because people don't want to be embarrassed. They don't want fear of failure. They don't want to be those types of things. So that is one of those default human behaviors that we have, that we are preferred to be someone of inaction because of those other mental barriers that we're facing. So this is perfectly set as a mindset minute, because it's all about changing the mindset. And so none of us will ever have perfect knowledge on any sort of real topic, and especially in the dismal science, which is social sciences and the economy and property. It's a dismal science, right? So, because it's a study of human behavior and human interest, and it's complex. So it's, there's nothing there. So I really love this message, Bryce, and that is, the FOMU, the fear of messing up. We've got to convince people that it's okay, right? And if you put some backstops and some other, defense mechanisms around you, you don't have to break the bank or, risk the whole bank in taking some progressive steps forward. And those people who do that get the greatest reward by taking action.
One of my favorite sayings, Ben, is walk a mile, see a mile, because once you walk that mile, you get to see another mile. And that's kind of the summary of the point here, right? It's once you take that first step, your view will become clearer because you're one further step in front. And so understand most people who, to your point around status quo, if we're going to lose through status quo and we're going to lose through having a swing, the same loss, we would prefer to do that through status quo, doing nothing. Because what we do know is, within our own business, for people who come and see us and who don't do anything, the story in your mind sometimes is, they might have gone somewhere else. No, generally a very, very large percentage of them have done nothing.
Yeah, the status quo. It wasn't worth, for whatever reason, they couldn't see the value or what they were doing, they felt fine with. Again, the juice isn't worth the squeeze, all of those things. But in a lot of cases, the difficult conversation internally that we all need to have is, am I just fearful of making a mistake? And that fear could be holding me back in life, and in certainly wealth creation, and as you put it, in terms of financial peace. And we agree with that statement because we see it every day. And that's part of the motivation, people being done with money. The other part of the motivation in setting this podcast up in the first place is to move the dial on that mindset. So, and that, so if you're having reflections on what Bryce has just mentioned about feeling silly, we get it. We've all been out of our depth in conversations and subject matter knowledge and those other things. So you absolutely need to build knowledge, but to think you're going to get to perfect knowledge is a dream. It's a myth. So having informed knowledge, mitigate risks.
So you got it too, hey?
I got it. I've got the disease.
So, folks, here's the question for you as you reflect on this mindset minute today. Whether you're on the train, whether you're exercising, whether you're driving in the car, whether you're doing something else, do you have FOMO? Do you have FOMO? And if you do, it's okay. But just understand that could be the biggest barrier that overcomes you from getting the success that you want. So have a think about that. Hey, rip a show today, Ben. Let's rip into it. We had a conversation a little earlier today with one of our favourites, Julia Hartman. Let's cut to the interview you and I had around home deposits made simple. All right, Ben, we've got a very special guest today, returning guest, Julia Hartman. She is the founder of the Ban Tacs Group, which is a national cooperative of tax accountants, which is a body of professionals who specialise in tax and property. She's also the chief technical tax advisor for our own business, Empower Wealth Tax. She's got books with Neil Whitaker, Saving Tax on Your Investment Property, Winning Property Tax Strategies. Welcome back to the Property Couch, Julia.
Thank you for having me, Bryce. Hello, Ben.
G'day. Thanks for coming on again, Julia. Hey, Bryce,
Yes.
Noel Whitaker, probably better than Neil Whitaker, but I just want to, sort of put it out
I'll
there.
say Neil. Seriously, that is a rookie mistake. Noel Whitaker is one of the OGs, Ben, of this entire country.
He is one of the goats.
So for me to show disrespect by saying Neil instead of Noel is not okay. But yeah, books with Noel Whitaker. But Julia, you recently wrote a blog which caught the attention of old mate Kingsley there. And we thought that we would use it as the basis for a conversation today that we think will have a lot of benefit to a lot of people, because the topic of today's episode is home deposits made simple. And what you've cleverly done is you've gone and had a little look into some of the nuances of opportunities that exist. And you found a way for people to actually use the incentives and the tax structures and the regimes that are available for people to get themselves a home deposit. Julia, what sparked this for you? Because it's, as we go through the episode, we'll see that there's some really useful insights that you've found. But where did the spark come from?
Oh, years and years and years of a particular selection of clients that just keep on wasting their money. And I think they do things like stop talking sense, or don't make me adult. So it would go year in, year out. They get them fat refunds and it's still going. So I thought, I've got to get the money out of their pay before they get it. That's the only way they're going to save. And that was my first cornerstone into looking into the super saver incentives. That was just the start of it. And then I had to show them how this was going to get them to a home one day. So that's when I looked into the low deposit schemes the governments are offering too.
Yeah, well, you've come up with a way for people to buy a home with $35,000, but also how they actually accumulate that $35,000 in a way that accelerates what they could probably do saving themselves through using that super first homeowner super saver scheme. Sorry, I was just looking for the exact title there, Ben. Thank you. But so I reckon we should set the scene here. Is it actually possible that people can buy a home with $35,000, Julia?
Yes, especially if they buy it in South Australia, because they have a great little scheme. But to sweeten the interest here, I want to say that of that $35,000 that they're going out to buy the home with, it's probably only $20,000 of it come out of their after-tax pay. So then they can go, oh yeah, I can save $20,000 in a couple of years. I just can't claim save the $35,000. But the government has all these low deposit incentives. So as you know, if you've only got 5% deposit, you have to pay a terrible lot of mortgage insurance. Mm-hmm. Whereas the government says, well, we'll be your mortgage insurer. We're not going to pay your deposit for you, but the banks don't charge your mortgage insurance because if you default, we'll pick up the tab with them. Now, the trouble is, of course, that that means that you might only have a 5% deposit and you've got to pay off a 95% loan. So that is the catch there. And in South Australia, they've got even cleverer, where they've said, well, we need to brain drain these other eastern states. So it's brilliant, I reckon.
Bring the talent in. Yeah, it's competitive. It's a competitive environment out there. Bring the talent in. Bring the talent home, maybe.
Yeah.
Well, stick around, folks. We're going to uncover why South Australia has got a little edge a bit later in the show. But the first home owners super saver scheme is basically, as a reminder, allows people to withdraw some of their superannuation to buy their first home, provided they've made some voluntary contributions first, right? So that's the important part. And you've you've come up with a way for people to make those voluntary contributions in an environment that is tax effective, that allows them to do what you just said, to get some subsidised help for the saving to get them up to that $35,000. So let's see if, for those folks at home, Julia's done a blog. We are going to make a link available to the blog, and we're going to do our darndest to make sure that we can explain it whilst you're listening today, because you won't be reading, you won't be looking at the details, and we'll try and make it as clear as possible. But there will be a follow-up opportunity for you to read the blog as well, that supports the conversation that we're having today. But let's set this up. You've said people need to save $200 a week from their take-home pay, and you've got some assumptions around that. So let's unpack that.
Okay, now to encourage people to go to the blog, this is just half a page in the blog, what I'm about to say. They see the numbers in front of them. I'm sure they'll get it. So imagine that you're on about $140,000 a year. Your marginal tax rate is 39 cents. So if instead you put let's give an example of $10,000. So you've got $10,000 before tax pay out of that $140,000, and you say, if I'd taken it in wages, I would only have $6,100 left after I paid my 39% tax on it. If instead I put that $10,000 into the super, then I got $8,500 left, because it's only going to get taxed 15 cents going into super, and it's still out of after-tax dollars. So you've got $8,500 working for you, and there's a little bit of earnings on that too. Now, there is a cap that you can only put $15,000 a year away by this method, but it's $15,000 after the 15% tax. So the key word is that you can put $17,647 into super.
Yes. Which nets to 15. Yep.
Yeah. Yes. But the trouble is that you're only allowed to put $27,500 a year in super in total on the concessional, the one that, you can put in before tax dollars. Now, if you're on $140,000 a year, your boss is already putting in maybe $14,000 in the superannuation guarantee for you. So you see you'll go over that $27,500 if you put $17,647 in as well. So if you've been earning this $140,000 for the last couple of years and your boss has been putting in $14,000, then you've got a whole lot of unused cap. In those previous years, it was $25,000. So you've got all this extra cap that you can save up over those years and use that to put more contributions in a particular year. So now you can do that. So for the next 2 years, you can do the $17,647 if you haven't been putting the maximum up in previous years. If you had put the maximum up in previous years, well, then you've got more voluntary contributions that you put into super that you can draw out for this saver as well. But what I did want to point out is it's not this is for single people, it might be $35,000 that you'll get through this with a bit of investment and earnings. But if you're a couple, you both get to do it. So you get double that amount.
Mm. So Julia, in stepping us through from an audio point of view, how many years can I go back for the contribution that I didn't make? So if there was a shortfall in that contribution, how many years can I go back to work out what additional amount I can put in one particular year?
You can go back 5 years, but it only started back in 2019. So you haven't got the full years now. And you can go on to MyGov. In your MyGov, it'll tell you what the amount is that you can go back and utilise. Okay.
So if I can summarise that, and this is about leaving money on the table, people, right? What we're talking about here with the $10,000 example is you're going to be paying $3,900 in tax to the tax office. If, however, you diverted that $10,000 into your super vehicle, you're only going to be basically paying $1,500 in tax. So it's up to you. If you're saving for a deposit for a home, then this is very much the best vehicle for you to do so. And as long as you follow the rules. But there's a $2,400 difference here, folks, in terms of that could be your money that's going towards you saving that deposit quicker for your home, or you could give it to the government to spend on some I don't know, silly program and, wasted thing that they often spend wasted money on, right?
Come on, Ben, you said fireworks before we started.
I thought that, but fireworks is the state-based thing. So there might be there'd be some federal national celebration. Maybe it's Australia Day, who knows? But the point being is they're going to waste it anyway. So why not keep that money for yourself to go towards you buying a piece of terra firma of Australia and buy your first home?
Yeah, and the difference that it breaks down from to put that into terms that when they get their pay packet is they give up $200 in their pay packet and they get $300 saved in super. That's the difference.
It's material, people. This is worth getting out of bed for.
All right, so that's a wonderful opportunity. I think it still doesn't. I think it's really important to note too, though, Julia. It still helps people who are on good incomes, aren't they? Because they still get greater tax incentives, but they also have greater servicing capacity. Because at the end of the day, you are helping people get into a property easier on the deposit stakes, but they forego the when you save up a bigger deposit, you got a less loan, which means less repayment. So they've got to have a greater capacity to service. So it still sort of lends itself to people who are still on strong incomes, right?
Well, it's always going to help because $35,000 isn't a big deposit, is it?
No. Well, we've got some scenarios to go through here, but clearly it's for people who are struggling with getting a deposit together. So it could be on good incomes, but that deposit's the hard bit, or as you've mentioned in your blog, Julia, it could be someone who's had recent difficulties that have actually passed. So there is a couple of assumptions. We'll get into the first homeowners guarantee that the government offers around who can qualify for the 5% deposits, but you've got to have never owned a home before, or as you point out, Julia, some sole parents can qualify for subsequent homes with the government guarantees. It doesn't necessarily have to be their first. And if they're doing it as an individual, they could qualify even though their partner may have qualified previously for a home if they're doing it individually, right? So there's a couple of things that you've put as assumptions in your blog.
There is some fine print, and also the lender's mortgage insurance guarantee is it's limited. They don't, there's a certain number to qualify and all that. And I guess this is an important point to say to people, to encourage them to continue to say, is that if you don't end up buying a home, you can get that money back out of super. If the program doesn't work for you, you're not locked in, can't get your money back. You can get it back. You've got to have, it's messy, but basically you pay a top-up tax to as if you had taken it normally in your wages in the first place. That's how it all spills out. It's not locked in. It's yours to take back out if you pay the tax back.
There's obviously lots of nuances and calculations in there, but the best way to describe that is you can't game the system, people. So in other words, you can't say, this is going to be great. I'm going to put this money in, then I'm going to tell the government, so I'm going to get a 15% tax in, and then I'm going to save up lots of this money, and then I'm going to say, I'm buying my house, government, thanks, can I have my money out of super? And then if you don't buy that house and you don't have evidence of that, guess what? They're going to ratchet in all of that tax back that you thought you were trying to beat the system on. So for those people, they've designed the system to that it says it does on the tin what it does on the tin, which is it's to buy a house. And if you don't use it to buy a house, we're going to claw back that tax money that you didn't pay us.
That's right. But in previous things that they've had like this, you haven't been able to get the money back out of super if you didn't buy a house.
Yeah.
So that's an important point for people. You hear that? Yes, it used to be like that. This scheme isn't like that.
And just coming back to the first home buyer's guarantee, if I can, the other eligibility point, which is quite important here, is for individuals, it's up to $125,000. For couples, it's $200,000 income. So we've done an example on 140, but it just gives you an idea that if you're also trying to access this scheme, and to Julia's point, it's been very, very popular. So we would expect that the government will announce a new intake for next year. We think this podcast will be evergreen for a period of time to keep referring back to. So most of the allocation has been very, very well received because you're not paying lender's mortgage insurance and it's a 5% and you're in the game. So it sort of makes sense to explore this if you're in that sort of income bracket that allows you to only have a 5% deposit to get into the property.
But you know how you get your 140,000 down to 125, Ben?
Please tell. That's why I set this up. Go for it.
it's the 125,000 taxable income. So if that year you've salary sacrificed your 15-odd thousand into.
Boom! There it is, everyone.
There it is. Very good.
Yeah, no, you can still do it. It's all right.
Yeah.
So,
well
Julia,
done.
you have 4 scenarios that we want to talk about. If you're a sole parent, if you're a couple with children, you're a couple with no children, or you're a single person with no children. So let's see how this impacts each and every one of those scenarios. So let's kick it off with the sole parent. What does it look like for them under this particular scenario?
Okay. Now, we're saying in each of these scenarios that someone's got themselves $35,000 worth of savings in super, and they've saved up a bit to pay the stamp duty or whatever, which they should get concessions on anyway. So for a sole parent, if they've got a child, they only have to have a 2% deposit. So that means, in theory, with a $35,000 deposit, they can borrow 1.7 million. So that's not going to be the issue, is it?
All right, everyone, just get out there, rock outside and grab yourself a sole parent, No.
But the point is, you've got to pay off that 98%.
Yeah.
Yes.
Of that loan.
Yeah.
And
Or you've got to service it. You've got to demonstrate serviceability first. You're not going to be able to borrow that much money.
Well, that's right.
Trade-off, isn't it? Because that's the group of people that are doing it the toughest. So
Yeah.
I think that the barrier to entry being the lowest is appropriate. But as you say, Julia, sure, 1.7 on paper, but the reality is that people will be a bit more modest than that.
That's right. So you've got 2 tests when you go to the bank. One is, have you got enough deposit? This gets you around that test. The next test is, can you afford to repay it? And that's going to be your big one, especially for sole parents, because you've only got one income coming in and you've got a family to support.
Yeah.
But it does help people, reestablish themselves and put a roof over their head in a modest house. It's not going to get you that amount. But it does get them started. It doesn't mean that they're trying to save a deposit while trying to raise kids. If they've got the income, they get into the house.
We couldn't agree with you more, Julia, about the importance. The biggest challenge in this country is sole parents who've had relationship breakdowns and their risk of falling into situations that are very challenging for them. So if they can, because super would normally not be enough, so if they can not fall into any type of poverty cycle or rent cycle where they can this is really important. Now, it might mean that Sydney and Melbourne might be out of the question in a traditional home setting or whatever, but city fringe, regional areas, new states to rebuild a new life, all of those things are on the table for these people. And Bryce and I say this so often that this is the group that fall through the cracks.
Mm-hmm.
And anything that the government can do from a safety net point of view that can help these people, we will support till the cows come home, because it's so important that everyone comes along on the ride, that wealth isn't just for those people who have high incomes.
Well, the problem is you can't save a deposit while you're raising the kids, and by the time you've raised the kids, the bank isn't lending you money because you're too old. So we've got to get them in the market somehow.
That's right.
The roof over the head in that scenario is just critical. So the opportunity here is, if you have a good income, then a modest home in most of Australia is possible under the scenario that you've just described. So that's a big tick with what you've gone through, Julia. So that's great. So sole parent, that's a tick. Couple with children. Let's talk through that scenario.
Well, they have to have a 5% deposit.
Mm-hmm.
But remember, this couple with children, they could both be working and have 70,000. So that gives them a lot of buying. But let's just say that ideally what you've had is one member of the couple's been able to use this super savings scheme while the other one's at home with the kids. Now the kids are off to school. Both parents are ready to work. So you've got this good capacity now to meet the repayments, but they've actually eroded their savings while one wasn't working. So they haven't got a big deposit, but they've got this 35,000 and they've got the ability to repay a lot better than the sole parent has. Now, that with 35,000, they could buy a house for $700,000 because of the 5% deposit. And that's just about it. It won't get you inner Sydney, but that'll cover a modest home, won't it? Anyway.
And when you do your budgets at home, it might be, okay, One of us is targeting the 35, the other one might do 50% of that. So we might be at 17,500. So it's all about working out what you need for essential living costs. There is obviously, there's going to be a trade-off and there's going to be sacrifices, so less discretionary spending. But the game here is to get you into the market. The more people we can get into property, this is what we're about here, the better. So there's a solution. So it doesn't have to be one or the other. It could be a combination of two. And the higher the deposit you can save without impacting the family budget is what we are encouraging you to do. But remembering that only a 5% deposit, it's all that's needed to get into the market.
Mm.
So to summarise that opportunity, then Ben, you've got an opportunity up to 700,000, assuming the $135,000 savings pool.
Yep.
So to Julia's point, that might not get you in a city, Sydney, but it should get you into a lot of areas for 700,000. So that seems like that's a tick with our 35,000, not for everyone, but a tick for a lot of people. So sole parent tick, couple with children tick. All right, so the next scenario for us to consider here, crew, is the couple with no children. So I think, Julia, what's important here is these people qualify the same as the couple with children, but we want to talk to maybe an eligibility point here, because in terms of ranking, whether or not they would have the priority that the others have, it would be questionable. So if you assume it's similar qualification to couple with children, but we're going to take a different pathway here, that they're not eligible to get it and they have to do the full 20% deposit. What does it look like for them?
Right. Well, if they've got no children, they have a good chance of being able to save the $35,000 each. So that gives them a $70,000 deposit. But with needing 20% deposit, that still only gives them $350,000 to buy a house with, which is not a lot. So they might want to go the extra year. And I don't mean a full year here. I still mean doing it within roughly 2 years. But because they've got these two incomes, they might have saved a bit of money outside of super. We can only put $15,000 a year into super each financial year. So they do it for 2 years. And then in the third year, they say to their employer, every cent I earn, put it into super, get it in there. In a couple of months, I'll have $15,000 in there. And they live off their savings. But they've got that tax bracket that the $300 they put, the $300 that they put in, they would have only taken $200 home. So they've got that tax advantage there. And then they can go and buy a house with 3 lots of $15,000 in there. And that is also with the fact that there's 2 of them, and that gives them $105,000 deposit approximately, because there's a bit of earnings in there. And that's allows them to buy a house worth $525,000, which becomes feasible again. And they might even have a little bit more.
Now, Julia, you've obviously positioned that calculation around avoiding LMI at all costs. So, and to the point that we were making earlier, the qualification could be there. You still got to scratch the itch. Like, you got to ask the governments about the opportunity and whether you will get a seat at the table, because, as I said, we think that they'll preference people who have children, because this is an affordability story. And so single parents with kids and obviously families, they're probably going to preference those people, considering that there's a limitation on the number of available spots for this program. So we've made that assumption. But as everyone knows, Bryce, what do we talk about on the Property Couch around LMI, lender's mortgage insurance? It is, avoid it when you have to.
When you can, embrace it when you have to, which is kind of in opposition to Julia's view on LMI, which is what, Julia?
I hate it. I make them sell their boats or motorbikes or anything. Don't pay it. It's money for nothing. Because even if you do default, the mortgage insurer will come after you to pay what they paid the bank.
Yes, it only protects the banks. That's right.
Tell us what you really think, Julia. I love that. But to your point, Ben, if you want to embrace, and it's outside the scope of this conversation of the podcast, which we're trying to do at 35,000 no LMI, you're sneaking in a little. Well, if you do.
Well, I think people would be listening to saying, no, I would probably still buy, and my borrowing power will be higher because it's dual household income. So for our very astute listener and community, they're sitting back going, is that right? When the point being is we're trying to frame it with no LMI being paid, but I just wanted to scratch that itch for those who are sitting back listening to this going, No, I wouldn't. Surely I wouldn't have to save up a 20% deposit to buy only a $350,000 home. So that was just explaining to that. Your borrowing power is far better for a household, even with kids, if you've got double household income coming in as well. So that's potentially where the trade-off is for you to whether you want to buy a property with LMI and pay the premium, or again, still potentially apply for this opportunity as well. Because if you don't get it, you can still get your money out, whether you get the 5% from the government for the first home buyer's guarantee. That's the big question mark, because again, it's a scarce opportunity. So you can't really bank on it. And we're making a judgment call that says the government might preference those households with single parents and also couples with children to get them into accommodation.
But we have no intel there, Ben. There's no insider trading. Still apply, all that sort of stuff, but we're just playing another scenario. So what we've done, Julia, is we've covered the sole parent, we've covered the couple with children, we've covered the couple with no children. The final scenario we want to talk about is a single person with no children. And to the point that we've just made around couples with no children, it's kind of ditto the above. However, there is a little loophole that you particularly like about South Australia. And given that single people with less responsibilities to other humans perhaps have an opportunity here. So what have you found here, Julia?
I get excited about it because it's such a natural way for a government to fill their state with people with qualifications. I love it when they use common sense and it doesn't cost anything really. So it's a brain drain to the eastern states. It's
a competitive tender.
If you've got a certificate 3 or higher qualification, come to South Australia and we'll let you with only a 3% deposit buy a home here, none of the other qualifications, just your 3% deposit, and the government will guarantee so there'll be no lender's mortgage insurance. And of course, houses are cheaper over there anyway. So you can just see the person in Sydney going, I'm never going to get a house. I'm fed up with paying ridiculous rents. They're going to go South Australia. Here I come.
Yeah, it's clever. They get the people shipping over in their 20s. They get them back in their maybe late 20s, early 30s. But a bit like the single parent or the sole parent, where it probably opened up a big scope of what their price point could be. The limiting part of this part of the conversation is around serviceability, right? So you go to South Australia, your $35,000 will give you a whole lot more opportunity to buy a whole lot more a whole lot more lending for a house, but you need to really determine how much you can actually service. And importantly, the cost of buying real estate compared to a lot of the places on the East Coast is a lot cheaper. So it's kind of a double positive there. You get the lower the deposit and you get the real estate that's a little bit more affordable, which can manage those servicing requirements.
Yes, if you've got to make repayments on 97% of the purchase price, but the purchase price is half of what you would have been paying elsewhere, what's that work out? About less than 50% really ability to repay.
Now, my final comment in this section, obviously today's show is all about, the biggest barrier of getting into the market is around reducing or the deposit that we have to save. So getting speedier, quicker time into market. I've stumbled through that, but hopefully you get what I mean. Don't also forget that each state and territory also have other types of schemes, and which we've been talking about and we've talked about on previous podcasts, which is the equity share schemes, which is also about potentially having a lower deposit and getting in. So if your deposit that your money that you're bringing in can still come through these other vehicles, so can still come through this super scheme, and you can still use that and also potentially apply for the state legislation and schemes as well. So
stamp duty reductions.
Yep, stamp duty reductions, what Julia mentioned earlier, and also these potentially shared equity schemes is another way of which you can skin the cat.
All right, Julia, wonderful insights as always. I wonder if you could stick around a little bit because we've got a couple of other guests that we're going to have a quick conversation with to add value to this topic today. But you gave me a little insight that you might have a little life hack that might be helpful. So if you could just hang around, Julia, that would be wonderful. But Ben,
we're going to take a pivot now and we're going to introduce a couple of other innovative type products that are also being produced by the marketplace to solve this problem around the deposits.
So let's have a little conversation. First one Michael Ragavan.
Let's cut to the chat that we're having in regards to these new innovative products.
All right, Ben, we've got a very special guest today who's going to talk about a unique concept, also in the home deposit space. We are talking with Michael Ragavan, who is the founder of Our Leg Up. Welcome to the Property Couch, Michael.
Thanks, Bryce. Pleasure to be here.
Good to have you, mate. We are excited to talk to you because you've been innovative. You're looking in the market for opportunities to find a niche that helps people get into the property market. So my first question for you, Michael, is with your product, what is the problem that you solve?
Yeah, so we're really interested in diminishing wealth inequality. And the number one driver of that in Australia is not owning a home. So that's exactly what we're going to pursue. Homes are our largest asset for most Australians, generally the most important wealth accumulation vehicle. But it's a shame that cost of living is increasing, interest rates rising, inflation rising, and many Australians are just locked out of the market and risking their future financial security. So we're tackling the biggest barrier to home ownership, which is that 20% deposit.
Yeah, it's tough, isn't it? So you're going after that. You're trying to help firsties get into the market with giving them a leg up, hence the name of the business, of this startup. Now, I should point out to our listeners that we're getting a very early look at your opportunity because this is for those folks who are interested in stuff, this is ground floor opportunity to hear what we're chatting about today. But okay, so if you're trying to solve the problem of deposits, how do you solve that problem?
Yeah, sure. So we're looking to get aspiring homeowners in with just a 5% deposit and without needing to pay the additional LMI charges or interest rate premium that comes along with it. So really getting in many years faster for just 5%. And how we do it is by creating a community around home ownership. So on the other side of the market, Aussies have a majority of their wealth tied up in real estate. And we've figured out a way to be able to access it and leverage it so that both sides of the market can win. So on the other side, your house, it's usually your largest asset, but there's really nothing you can do with it whilst you live in it. There aren't any dividends, there aren't any interest yields. Instead, you're paying council rates, you're paying taxes, there's maintenance. That's why Rich Dad calls it a liability. It takes money out of your pocket, doesn't put anything into it. But Our Leg Up has changed that. We've developed a platform to unlock Australia's largest source of investment capital, your home equity. So how do we do it? Well, we aggregate equity, not cash. And we take a charge against essentially the established homeowner's property. And then we provide it to the bank. And the bank can use it to cover the aspiring homeowner's deposit shortfall. So in this way, the bank pays us a fee for lowering their risk. We essentially distribute that as returns to the established homeowner. And the aspiring homeowner, well, now they only have an 80% LVR home loan and they can get in faster without the additional cost involved.
Wow.
There's a bit to lean in on, Ben.
Look, we are fortunate enough. We get reach outs from people all the time on the Property Couch around sort of innovation and what they're trying to do so they can get their message out there. Now, we were fortunate enough a while ago to have Michael reach out to us. And obviously, a lot of people that do reach out to us, we want to make sure that it's in the best interest of our community. And this is why this is a bit of an exclusive, because what Michael's talking about here, just so we can get some context. So LMI at anything above 90 to 95% is quite expensive. Like we're talking, especially with the size of mortgages that we have to get these days. So we're talking in the sort of tens of thousands of dollars that it costs to have a loan to value ratio in that sort of space. If you want to get a mortgage and you want the bank to insure themselves against you as a risk, that's what lender's mortgage insurance does. Now, what's also interesting about what's happened in the last couple of years is that lenders are also now pricing in LMI into their interest rates. So the risk of the higher loan to value ratio, you actually start receiving or getting charged a higher interest rate on the money that you need to pay back for the banks. So what Michael's proposing here is quite interesting in the sense that if you get that LVR below 80%, you're actually at some of the most competitive interest rates from those particular lenders. But again, Michael, this is a novel, inventive product. And the other side of that you're talking about there is potentially getting a return on investment out of the equity. And of course, a lot of our community are investors, and a lot of that community may not be able to continue to keep investing into their portfolio because of the current situation. But this is potentially an opportunity for either, again, home equity or investors who have equity in their investment properties to potentially get a return. So talk us through that piece in a little bit more detail if you can.
Yeah, sure. So home equity is actually the largest source of capital in Australia. It's 7.2 trillion after mortgages. It dwarfs the ASX at 7.2. It dwarfs all the Australian super funds at 3.4 billion. But it sits there and it's largely uninvestable. And so we've figured out a way to tap into it and help generate a return, roughly 3 to 5% per annum. And so how do we do that? It's by taking a charge against it and providing it to the bank to diminish their risk when it comes to these aspiring homeowners loans. And in return, they give us a fee and then we distribute that. And so what's interesting there is that what we would deem as inaccessible equity, so literally equity that you can't access, that you can't get a loan against, that you can't go out and buy a property for, which has a $0 cost of capital, opportunity cost, suddenly has a rate of return that can be as high as 5% per annum.
Now, you have an investment banking background, Michael. So for those who don't have an investment banking background, break down a charge. How does the charge work? What does that mean? And why are you getting a fee for providing the charge, which you then distribute to the investors?
Yeah, sure. So a charge, we call it an equity investment. It's essentially a mortgage and a guarantee that's taken over the established homeowner's property. There's no cash involved. It's just that guarantee. And we aggregate that and provide it to the bank. And for the bank, it lowers, this gets a bit technical, but their risk-weighted asset, and it stops them from paying essentially their most expensive form of capital, source of equity. It's called common equity tier 1 capital. For that, they pay us a return. And so we distribute those returns to the investors. And suddenly they have inaccessible equity, which they couldn't get a loan on, which they couldn't use to buy another property, with a $0 opportunity cost, now earning a return between 3 to 5%.
All right. I've got a property that has a 50% loan to value ratio. Now, if I want to continue to keep investing, Michael, I might want to use 30% of that for a deposit for another property in the future. But I still have a remaining 20%, which takes me up to the 100% of equity. So are you just talking about potentially, you might have mentioned that it's the equity that may not be accessible in the first instance, because in theory, as an investor, I probably don't want to go up into the 90s or 100% sort of loan to into those high LVRs if I'm a mature investor. Is that the sort of area that you're talking about? And when you say an equity, is that a caveat that's placed on the security of the property?
Yeah, sure. So generally investors over the years, their income will grow, but certainly the size of their portfolio and the equity in their portfolio grows much faster. And so their ability to borrow against the entire amount, even at the 80% mark, isn't going to be quite there. Perhaps they can borrow against 70% or 60%. And so we go up to that 80% mark in terms of taking a charge over it, and we take a mortgage over it. So not necessarily a caveat, it is a second ranking mortgage, but it has no loan associated with it. So there's no interest or there's no cash out associated.
That makes sense.
Yes, it's lazy equity, for lack of a better term. It's equity that's sitting there that can't be utilized, that you can actually then return. So okay, so that's how you fund what you're doing and provide interest to the investors to give the charges up so that they can then give it to the bank so they can lend it. What about the person who wants to buy their first home? Let's talk from their perspective.
Yeah, sure.
How would they use your product to actually help them overcome? Ben sort of hinted early on around the premium for interest rate and the high LMI. How do you overcome those two things?
Sure. So instead of having to pay LMI, instead of having to pay a premium interest rate, they pay a much lower fee. And so if we take an example of a $600,000 property with a 5% deposit, so $30,000, generally the LMI there would be 4%, so $24,000, and there'd be an interest rate premium of say 0.2, 0.3%. With using our leg up, they would save over $13,000 in that example. And so it's quite a significant difference. And they can access the product from any of our partner banks, similar to how they access LMI, just a tick box that their broker or themselves can select when they apply for their mortgage.
So, Michael, that's obviously, and this is a this is the sort of first time this has probably been more broadly communicated out into the marketplace. So we're calling it exclusive on the Property Couch here, but tell us about where you're at in terms of the product journey, because this is serious innovation in this space. So tell us, where are the legals at, where are the negotiations with the different banks at, and, what's next, I suspect, is the question.
Sure. So this has been in development for about 14 months now. And before we started any of it, we wanted to make sure that it made sense, that it was a positive sum relationship for the aspiring homeowner, the established homeowner, and the bank. And so there was a lot of financial engineering, credit models, risk models that went behind it. And then once we figured out that the numbers stacked up, we spent a lot of times essentially going through the legals with tax barristers, financial services lawyers, the whole range. It's cost quite a bit, but we've got 90% of our investment product suite ready to go. And we're also in discussions with 2 large banks who are quite keen on distributing our product. And we're pretty close to getting it out. So hopefully you'll be able to see it in market first half of next year.
So someone goes, "Oh, this sounds pretty good, Michael. I think I'd love to find out where that tick box is where I can put that in." So how do they know if they're an ideal candidate? How do they know if that tick box with their mortgage broker or their lender actually works? What's the typical profile of a first home buyer look like to qualify for this?
Sure. So anyone who has genuine savings of 5% who's looking to purchase a property, in most areas around Australia, there are certain places that we avoid, so mining towns and things along those lines. But essentially, most areas around Australia with a 5% deposit is really what we look at. In terms of how they would go about the process of applying, essentially going to their broker, and if they have our partner banks on their panel, then they can easily select us when they apply instead of LMI.
So there's an education process which, let's say hypothetically the 2 banks agree this is going to be a product. They've obviously got a business development team of people that go out and they will be talking to the brokers about this as being an alternative option. And so that will get the message out to brokers. And then as a broker, so I put my broker hat on, so I'm now educated that you're talking about not taking that last 20%, but looking at potentially, if I've got a 40% loan to value ratio in a static asset, I've pretty much got my portfolio built, but I'm looking at some top up yield and some top up income. I can potentially lend 20% or 25% of that through this scheme. The bank takes that, and it's a triple win, like what you were saying before, in the sense that the bank obviously gets a loan. They're making profitability on that loan. You're getting the margin in terms of, obviously, because this is a better security, which means that the price of money that the banks are accessing that in the money markets, you're getting a differential of there, which is what is going to allow you to pay that 3 to 5% return to the property owner who's effectively putting a second mortgage on their property to receive income from that lazy equity. And then finally, you're bringing it in to sort of say, for those people who might have small deposit, but professional jobs, and they want to buy a more significant first home. But the reason why they didn't want to buy that significant first home was because the LMI premium was going to be in the 20,000+ range and the interest rates were going to be excessive. You've effectively reduced their costs. So they've also got a win and they're getting into the market in the first instance. So that sums up why my interest spiked when you first reached out to us, Michael, because I see this as being something that, this is what this episode's all about. It's about barriers of entry of getting people into property. And we're talking about homeowners, not investors here. We want every Australian to eventually own a home. And here you are giving us another vehicle to be able to do that. So for my final question, what I'm interested in understanding is, how do people learn more about what you're doing? So if I'm the first home buyer, where do I go to? If I'm the investor, where do I send my inquiries?
Sure. So www.outlook.com.au, we have a page for aspiring homeowners. We have a page for established homeowners. If you're looking to be on either side, you can give us your email address or inquire, and we'll send you some follow-up material so that you can learn more about the product, see if it's suitable for you.
There are some very good sort of how it works through there. So my final question is still a tactical question for you, Michael, but it's is there limitations on price? Do people have to be first home buyers, or could they have owned property before? You know, Ben said you're not looking to help people buy an investment property, you're helping people buy their home. What sort of criteria do you look for eligibility?
Sure. So the only criteria is that you have at least 5%. You don't have to be a first home buyer. It can be for investors as well. So happy to support anyone trying to get into the market with a low deposit. In terms of the maximum, right now it's at around $3 million, but we'll work towards trying to make it higher.
Okay. What's the thought process in terms of helping investors as well as first home buyers? Are you just seeing like, well, it's an opportunity, we're providing an opportunity, we're not specifically just going for home ownership? Because I guess that was part of the, the initial discussion at the top of this interview, that you're saying, that's where the divide exists. Is there any reason why you're opening up for investors as well?
Yeah, sure. So our primary customer is the aspiring homeowner, and that's certainly who we want to benefit the most. In terms of helping investors, generally they would use the equity in their initial property to try and purchase another property. So it'd be unusual that they were to sort of go and use our product. But if they wanted to, then the way we think about it is perhaps they're rent vesting. And so they don't actually have their own property. They're still buying their first property, but it's a rental instead of one that they're going to live in.
Yeah, well, that makes sense from a rent vesting point of view. I agree with you that if I'm trying to release equity and go again, I'm not necessarily going to be looking at this product. But it comes back to your purpose and your mission, doesn't it, Michael, in terms of you're trying to ensure that you bring everyone along on the journey, as we love this idea that every Australian should own a property. It's going to be a critical asset as part of the wealth creation and the financial peace journey that they're going on. So, hey, mate, I just wanted to say thank you very much for coming on today's show. I'm sure this episode will be listened to. It'll have an evergreen element to it, right? Because ultimately, what we're talking about today, in a sort of a softer property market, and first home buyers, like everyone else, are a bit more challenged in today's market. But I suspect as interest rates eventually pause and the market starts to show some signs of life, your timing in terms of potentially releasing a product like this in the first half of next year could be quite interesting. And we'll obviously keep an eye on it and put any announcements out there for people once we know that the product is live, because it's really innovative. I really like what, the critical thinking that's being done here. And I think there's definitely on both sides, there's an audience that you can serve on both sides. So credit to you and the team for putting all that information together, and we wish you all the best.
Thanks, Ben. Thanks, Bryce. It's been a pleasure being on the show.
Thanks for joining us, buddy. All right, Ben, a very unique way to look at the idea, because not only is it good for the person who wants to get on the property ladder, but it also helps people utilise some equity that they would otherwise not have been able to touch. So good thinking there. I think it is. I mean, it brings the three parties together, the lender, the borrower, and the equity provider, and everyone's winning in that particular space. So really interesting idea from Michael and his team there. Be interesting to see how much we learn about the release into 2023. Love it. Exclusives too, Ben. We love exclusives. But we've also got someone else we want to talk to, Ben, who's got another spin, another angle, another unique way to look at solving the pain on how you get that first deposit, Ben. So let's have a little listen to the conversation we also had recently with James Bowe. All right, Ben, another very special guest today to contribute to our topic around deposits and people getting onto the property ladder. We're chatting with James Bowe, who is one of the founders of OwnHome. First of all, welcome to the Property Couch, James.
Great to be here. Thanks for having me.
Yeah, we're excited to chat to you. You've got an innovative solution in the marketplace. We want to really look under the bonnet and help our listeners get an understanding of what it is that you do. But first of all, let's set this up. What is the problem that OwnHome solves?
The problem that we set out to solve is really helping aspiring homeowners overcome what we see as the largest barrier to home ownership, and that's the upfront deposit hurdle and stamp duty. We are focused on tackling the challenge of how enormous deposits have become for the average aspiring homeowner right around the country. So that now averages around $300,000 in Sydney, once you account for stamp duty for just the median, home in Sydney. And so that's the challenge that we're really focused on. More specifically, it's really the challenge that faces those who lack access to the bank of mum and dad. What we see today is that intergenerational wealth is really increasingly the deciding factor in whether or not you're able to achieve the security of home ownership. And 2 in every 3 successful first homeowners does rely on the bank of mum and dad. And that's obviously support that's not available to everyone.
Is it a personal crusade? Is this something that you needed to solve the problem for yourself, James, or was it just something? Where did the idea spark from?
Yeah, so certainly like a challenge that I had lived and breathed myself. 1 of 5, idyllic upbringing, but certainly no access to the bank of mum and dad. And when I sort of reflect on what had been some of the things that, the largest driver of some of the biggest life decisions for me, it had been, what are some things that are going to potentially set me up to have a shot at, building a deposit? And for me, that took me overseas for 7 years. For my co-founder, that involved starting OwnHome. So Tim, my co-founder, is a happy OwnHome customer. I'm sure there were probably simpler ways of getting him into his own home, but early mission accomplished in the journey of OwnHome so far.
Now, in terms of, we've obviously set it up nicely. So let's go through the mechanics of what's going to happen in terms of, so instead of having to save the $300,000, what do I have to do? And sort of how do you get me in quicker?
So in terms of the mechanics of how OwnHome works and how do we really help customers overcome that deposit hurdle, there's really 4 steps to that journey. Step 1 is applying for OwnHome. And just like a bank, we're asking the same questions based on your income and expenses. What can you afford on a monthly basis? And that's going to determine your buying power. And so once you're armed with that buying power, you're onto the, step 2, which is that property search journey. And here, we're in your corner helping you sort of price negotiate, do the due diligence on the properties that you want to buy off the open market. And if we're successful in purchasing that property on your behalf, or at step 3, you're living in your home. And at that point, you have a lease and option agreement with OwnHome. And that gives you the right, but not the obligation, to buy that home back from OwnHome at a pre-agreed price. And that pre-agreed price is the price that OwnHome buys it for on day 1, and then grows at a pre-agreed rate of 3.8% per annum. But all the while, a third of your monthly payments are going towards the accumulation of a deposit towards that property. And so that serves to effectively offset that pre-agreed price growth. And so what you'll find at step 4 is sort of bank finance, unless you've come into some fantastic inheritance or won the lotto, that will be the journey that you take, which is taking out a mortgage to purchase that property. And what you'll see is that you've effectively frozen the size of the mortgage that you'll need to take out, and you're able to sort of exercise that option to buy any point from the end of year 2 through to the end of year 7.
So 3.8% predetermined price, the market moves, I don't know, let's just call it 4.5, 5, right? So there is an opportunity there for the person who's buying to go, okay, well, the market value is increased at a rate that's greater than that pre-agreed term. So I'm building in some additional equity that will help me with step 4, right? Or do you have a mechanism to share that?
No, that's exactly right. I mean, we're really focused on how do we deliver the benefits of home ownership as early as possible. And there's a few dimensions to that benefit, those benefits of home ownership. One is certainly just like the ability to share in the capital growth of that property. And so what our customers experience is that they're capturing all of the capital growth above 3.8%. So if that's grown at 5% per annum, all of that is accumulating to our customer. Another dimension, of course, is just being able to confidently undertake renovations and really turn your house into a home. And so, one of our customers has just put an in-ground pool in because they know that for all intents and purposes, that is their property. They're just building up that deposit towards it.
So, James, what we've got there is really a story of, and we mentioned this earlier in this show about saving for a deposit. We've in the past on the podcast, we've talked about this idea that if you keep saving, you want to keep saving if the property market's flat or not necessarily moving. But if you can't save as quick as the value of the property is growing, then this is an opportune time to obviously come into that market. So when you think about, your particular audience, what sort of market segment comes into mind for you that you think is your ideal customer?
Yeah, it's actually a really good point that you raised, just about sort of the decision process for anyone to purchase a property. And really, a really no doubt underlying sort of component of that thought process is, I think this is a wise investment. And why do you think that it's a wise investment? It's because you have a view that that property or that region or that city is going to see price appreciation in homes over, or that specific home over the long run. And different models have different sort of, what you need to believe components to that property price growth. A mortgage, actually, if the property is flat, and you sell it 5 years later, you've actually lost money because there was stamp duty and perhaps there was LMI impost at the beginning. So there's always sort of a component of, like, no doubt some level of property price growth that anyone is contemplating when they take the plunge, whether that's a mortgage or whether that's with OwnHome, or any of the sort of first home loan deposit programs and support, mechanisms that are out there. In terms of who are we solving for, it's very specifically those who lack the upfront deposit, but are more than capable of servicing the monthly payments of a mortgage. And so what you'll see with OwnHome is that it is slightly more expensive than a mortgage in terms of a monthly cost. So you won't suddenly be able to afford a home with OwnHome that you would have otherwise not been able to service with a traditional mortgage. So very specifically, we're there to support and are able to support customers that are more than capable of servicing a mortgage, but just need time to build up that deposit.
So if I'm someone who's a first homeowner, I come to OwnHome, it's 3% upfront of the purchase price. That's correct. Yep. A portion of that, I think, correct me if I'm wrong, 1% goes towards, effectively that's your first stake in the ground for equity. 2% is helping you fund stamp duty and costs. So, but you've got to run a business, right? So, and after you pay for stamp duty, I'm not sure there's a lot of change left on that initial upfront. So, how do you guys continually have a business that's a going concern? You hinted at it with the monthly cost being higher. So, I'm sure there's a service fee there. So, there's part A of the question. And part B is, okay, so you've got to stump up with a bunch of capital as well, because if someone's putting up 3%, which becomes 1%, and you traditionally get 80%, you're going to have to bridge the gap. So do you have big capital reserves, or have you got a relationship with the bank that says, if they satisfy the criteria and they follow your bouncing ball, we're happy to guarantee it up to a higher LVR? How does that work for you as a business, so people can go, these guys need to stay in business for this to work?
Yeah. So I guess any business that's financing home purchases on behalf of customers, whether that's mortgage providers or whether that's OwnHome, where we're actually on title for a period of time, they're stumping up the capital. And the basis of really all of those business models is the difference between the cost of funds, whether that's a bank's cost of funds to fund that mortgage, or in the case of OwnHome, it's OwnHome's cost of funds and the revenue that we generate from our customers. And the way that we make money is really the difference in terms of the monthly payments that we receive from customers and the monthly cost of the capital to support that home purchase. Really as simple as that. And so on a monthly basis, OwnHome is slightly more expensive than a mortgage, but that sort of recognizes the fact that notionally this comes with less of a capital buffer, so to speak, that's being contributed from the customer. So banks are able to offer incredibly low rates for a whole bunch of reasons, but one of those, of course, is that the customer has contributed, 10 or 20% capital buffer. And what's actually going on there is that the customer wears the loss, so to speak, in the context of sort of a bank mortgage. In the context of OwnHome, across a whole portfolio of properties, OwnHome is really sort of the resilient owner of all of those homes for a period of time. But the way that we make money is not through, capital growth, because effectively, if you recall, we've effectively frozen the amount of bank financing. It's very explicitly the monthly payments that we receive from our customers.
And James, you mentioned a period of time between the sort of 2-year and 7-year exit. You said it was a predetermined date. Can that change if circumstances change? Like, am I flexible enough? Let's say we set a target based on the terms of the agreement that it's 4 years and 6 months, but then something comes up or there's some difficulty in terms of coming to that time. Can I push that agreement out further?
Yeah, it's the option for everyone is actually 7 years. So, and you can exercise that at any point from the end of year 2 through to the end of year 7. So you don't need to predetermine at the outset, like, I think I'm going to be able to get there in 4 and then ask for an extension. And really, the 7 years, if at that point in time, our customers need an extension to build up a larger deposit, or there's been a change in circumstances, the most logical thing to do is really to simply just extend that option. And as you recall, the way that OwnHome makes money is through the monthly payments. And so why does that 7-year, time expiry even exist? It's really because we exist to support our customers in becoming full homeowners. And we're not, in the business of just creating sort of like permanent renters. And so we're really looking to set our customers up to be mortgage ready, ideally as quickly as possible. And that's, what motivates us in building OwnHome.
And then the assumption is, obviously, I'm not paying LMI because I'm not buying the property. Effectively, you're buying the property. So again, I don't have to save that 20% deposit. And the assumption is that if I'm renting, it's going to take me forever to potentially save a deposit. So rent money is dead money. So rather than rent, I might as well try and get into my family home. And then if I'm finishing off that assumption, the assumption is in 7 years, the agreement sort of assuming that there will be 20% equity in the property, which means that when they do go to refinance to buy the remainder of that property, they're not going to come into LMI territory. Is that the sort of broad thinking in terms of the timeframes?
Yeah, exactly right. We hear time and time again from our customers that they're really eager to avoid LMI. And, when we ask customers, like, what are the feelings around that motivation? And it's because, LMI is for the banks, it's not for us. And there's an element of sort of that lock-in risk, which is if I want to refinance, but I haven't hit the thresholds that allow me to get rid of LMI, then I might have to pay LMI again, which is kind of crazy. And so there's that feeling of LMI, which is like, they didn't contribute anything to the deposit and I'm paying this money each month to LMI, or it's capitalized on my loan, et cetera, et cetera. So it's definitely like a visceral feeling that we hear from our customers. And that's absolutely the intent, is that our customers will have equity greater than 20% that allows them to avoid that LMI cost. Yeah.
Does capital gains tax apply to you when you dispose of the asset, given it's trading stock rather than investment stock for you?
Yeah, good tactical question. Capital gains does not apply. It's sort of just company income effectively. Because
so when you trade out through the properties, that's not considered a capital gains tax event. So that means you're not up for giving away a fair bit of which helps with the market. Otherwise, you'd have to charge a bit more on the exit.
Yeah, I mean, it does mean that OwnHome doesn't get capital gains discount on that income, but there's a lot more input costs that you can deduct against, typical company income. Yeah.
Is it a tease for you to know that the New South Wales have now passed a legislation that says the stamp duty choice for firsties can be large upfront or an annuity? And given that OwnHome will own the title rather than the person who's buying it, does that mean, I should ask the question, does that mean there's not a technicality that you don't qualify for that option?
There is a technicality that OwnHome doesn't qualify for that option because we ourselves are not first home buyers. But it's really exciting for all of our customers that many of our customers qualify for that program, and all of the customers that we've spoken to that are eligible are going to take up the property tax option and are incredibly excited about that.
And it's because, are they eligible for it because they're taking a small percentage of ownership as opposed to
they're eligible for it when they buy the property back from OwnHome. That's if.
Gotcha.
Yeah, it survives.
And obviously that helps.
The March election.
Again, setting that sort of 7-year end time frame, but any time in between that, ultimately, again, if they feel comfortable enough and they can get finance after 2 years, and there's enough equity, and hopefully they avoid LMI. Let's say it's had another 15% run, because property doesn't just boringly go up in sort of a linear way. It goes up in spikes and in bursts and then cools off. So ultimately, that's what's going to play out here, is that there's going to be lots of customers coming back to you who, again, have really just said to themselves, I'm not going to wait. I'm going to basically, I want my home sooner rather than later. I know I'm going to pay a premium for it, but that's part of that, as opposed to paying dead money in rent money. So they're sort of making a judgment call that that's where they want to move to. So that's an interesting model in terms of seeing how that will play out over the next 3 to 5 years, where property prices go, which is all going to be pretty much determined by interest rates and because we know that there's going to be a lack of a lack of supply as we come off the end of sort of 2023. So it's going to be interesting to see how that plays out.
Yeah, it really will. I mean, we exist because we believe that the upfront barriers to home ownership are, the greatest barrier, and stamp duty is such a huge, regressive barrier for first home buyers who don't have, say, like equity built up, that means that the subsequent home purchase, like stamp duty impost, is, ain't nothing but a thing. For first home buyers who aren't able to draw on, equity in an existing property, it's such an immense barrier. And so we at OwnHome are incredibly excited about the first sort of pioneering steps, and do think it's a broadly regressive tax. Are excited about, the test case that this provides for the country.
James, Ben's the really sharp one in this duo, and I'm the one that takes a little bit longer for things to land, right? So can I just lean in on the capital? You buy it, you get 80%. The person who's buying it's got 1%, but there's a difference in between. Do you have a build-up of reserves to provide that security to the bank as a proxy on behalf of the buyer that brings up the difference between the 80% that the bank will lend you and the difference between, because the person who's buying it's not giving you 20% deposit? Where is the capital reserve or the security or the deposit that you as a business need to demonstrate to the lender coming from?
Yeah, OwnHome is actually buying the entire property outright. So for the vendors that we're buying homes from, OwnHome is a cash buyer. And so we have financing that supports our home purchases. It's actually more conservative than your typical 80% leverage that a first home buyer will pursue. But so that those homes sit on our balance sheet, and we're cash funding those home purchases.
So you've got additional reserves or facilities that provide.
Yeah.
Okay, gotcha.
Yeah.
Gotcha.
Whereas, say, LMI, that is simply just an insurance product that you're paying a small amount, and effectively the bank is saying to that insurance provider, if anything goes wrong, promise that you'll help cover the gap. And so there's that sort of like promissory commitment, which is, if things go awry, I'll do my best to stump up some cash to cover your loss.
All right.
That is not what OwnHome does. Yeah.
I've got a property on Kangaroo Island, James, that I want you to buy. Do I qualify for you to buy it? I'm sure there's limitations. Let's talk through those.
Yeah, so sadly not yet operating in Kangaroo Island, and very specifically, the families that we're serving today are able to buy homes from Wollongong up to Newcastle in New South Wales, out to Campbelltown, so sort of really greater Sydney, and then southeast Queensland, so greater Brisbane to the Gold Coast, and those are the two markets that we're operating in today, and ultimately Eastern Seaboard, and then capital cities right around Australia are sort of next stops, so to speak.
So for those who are in Melbourne, the other big metropolis in Australia, was sort of a rough timeline, James, of when you think you might be operational down here?
Yeah, expect Melbourne to be a market that we serve over the next 12 months. And I believe we've seen over 5 billion in applications from folks in Victoria. And so are very excited to expand soon to Victoria and Melbourne specifically.
Well done, James. I think there's, you've taken an opportunity. You've seen, you found a pain point. You've found your unique way of solving that pain point, and you've created a business model that not only is profitable for you guys and all of your major and minor shareholders. But it's a good opportunity for someone who wants to get on their foot on the property ladder in a unique, different way that are struggling with the barrier that we've been speaking about on this whole podcast. So I just want to say thanks to you for joining us and sharing your concept. I'm sure there's some exciting things ahead for you. But mate, well done on having a swing at what is for us a foundational principle to try and get as many people in property as possible. And the way that you guys are doing it is a unique spin on it. So well done.
Here. Well, thanks for covering such an important topic in this week's podcast, and really honoured to join you both. So thank you.
Thanks, James.
All right, Ben, another unique solution to getting on the ladder.
Yeah, I mean, it's just great to see this innovation in this space.
Well done, James. How good is it, Ben, to get the front row seat of having some of these conversations with these people who are looking to solve problems? It's a wonderful thing.
I tell you what, this is that classic case of where, problems and human ingenuity, that's what we are as humans. We solve problems. And then so these businesses have seen opportunities to solve problems. And James with OwnHome is looking at a novel way of solving for that. Got a capital, going to buy the house for you. You get in there, you don't have to pay rent. It's another win-win outcome when it comes to those people who feel like they can get into a home sooner rather than later.
All right, Ben. So there's hopefully a comprehensive way for people to get into the marketplace, get their foot on the property ladder. That was the mission of this episode at the very beginning. We've now shared a bunch of ways that people can consider.
Reducing their FOMU, Bryce. Reducing their FOMU.
Thank you for that link. I appreciate that. You were listening to me. You are listening to me these days, which is good. So you're right, fearing their FOMU of getting onto the property ladder. But life hack time, Ben, and I asked Julia to stick around so that she could share her life hack with us. So I think it's a good one. So Julia, what have you got for us? All right, Julia. So we've covered a fair bit today, and the whole idea of this podcast is to make home deposits made simple. You've made a massive contribution to that, as per a couple of the others as well. But so we want to thank you for looking into the legislation and looking for creative ways to help people get on that all-important first step into the property ladder. Now, before you go, I normally do a life hack at this point, and you gave me a little nudge to say you reckon you might have a life hack on CGT and record keeping. So I thought I didn't want to waste this opportunity while we've got you. So what's your life hack around CGT obligations and some of the record keeping that needs to be done with that?
Well, the biggest and best tax strategy, in my opinion, is having good records. And when it comes to finally doing the capital gains tax calculation, there's masses of stuff missing. And if you die, your executor's not even got any idea whether these shares were pre-85. They might know with a house, but with a house, there's a lot of things that you could have increased the cost base by that won't be recorded anywhere. So I spend so much time telling people, capital gains tax applies, you need to calculate. Now I've finally given them a way to get all this stuff out of folders, out of shoe boxes, away from floods and fire, and get them in a spreadsheet. I am so excited that I've discovered that Excel allows you to scan a document and link it into the spreadsheet. So imagine getting all your affairs in order, all there. And someone comes along, like a taxman with his little bowler hat, wants to tax you, and you go, tick, see, there's the statement for this, there's the statement for that. It's all there, and you total it up. It's great for planning your estate to make sure there's a fair distribution of who gets what after the tax is paid if you're transferring things in species, which is what you want to do because that saves capital gains tax. It's a wonderful way of even for young people to get off on the right foot, start putting their stuff together, even use this to put in your birth certificate, your marriage certificate, all that. But people don't even realise how easily they're exposed to capital gains tax. I know the tax office is unlikely to discover this, but if you gift jewellery, you're supposed to pay capital gains tax on it as if you sold it to the person at market value. But also if your home's on more than 2 hectares, that property is up for capital gains tax, and you need to keep all the records to a portion, like even cleaning materials can increase your cost base. It just goes on and on and on.
So, Julia, I want to sort of pause there and say, rightio, we're going to do Talking Property Tax with Julia Hartman. We will share it with the community. We will take a big deep dive. But effectively what you're telling me is this is an accountant's wish that good bookkeeping can help you save tax. And you have created this spreadsheet. So I want to do a little bit of a shout out to you. We'll put it in the show notes where you can learn more about this particular opportunity that Julia spent basically 12 months in pulling all this together. And it's just a great place in which you can store some of those records. So check it out in our show notes. So you can have a look at that and you can get that affairs in order. And why is that important? Why is that related to today's show as well? If you think about first home buying, it's probably not your dream home. And in some cases, some of you may be actually really fortunate enough to turn that owner-occupied home into an investment property. And so keeping those records, keeping an understanding of your cost base and all of that, when you do potentially switch it over to an investment property, is also going to be helping you in terms of the capital gains the capital gains tax.
Well, you got excited then, didn't you?
I did. The capital gains tax if you choose to sell that property down the stretch. So check out the show notes in terms of that. And hey, Julia, we love having you on the show. It's awesome in terms of the information you bring to the table. That's why you're our chief tax expert at the Empower Wealth business, and you guide us in terms of all of the nuances around property investing. That's why our team, Danesh and Takiba, are so beneficial for all the work you do. So thank you very much for coming on to the show. And I promise we're going to take a deep dive into this record keeping story in our Talking Property Tax that we'll put together in the new year, and we'll tell more people about this exciting new product that you put out in the marketplace.
Thank you, Ben. Yes.
Thank you, Julia. I appreciate it too. And Stiggy, I think I'm going to do this more often. I'm going to outsource the life hack to Ben, to Julia, and all the guests. This is wonderful, mate. But so, mate, on that note, Ben, what's making property news?
Well, mate, obviously the biggest news that has occurred in the last 7 days is that the legislation in New South Wales changing the way in which firsties, so it's a great theme story again, first home buyers, another opportunity for them to reduce the amount of money that they need to save to get into the property market. So.
Yes. Particularly in the state that needs it the most, Ben.
Particularly in the state that needs it the most, Bryce. Well said. So from my point of view, I was critical, just summarising, I was critical of the original idea that they had. It was going to create a two-tier market, a lot of uncertainty. I don't like uncertainty in marketplaces. You know what happens, there's unintended consequences of that. This, however, on the other hand, I think is the best policy story that I can see for helping people get into the property market. In fact, I'm even staggered why the Labor Party would say that they want to repeal this legislation if they win the election. I thought Labor was all about helping people get into accommodation. It's unbelievable. Anyway, another story. Here we go. So just a quick analysis here for those people who want to understand it. $1.5 million property bought as at on Saturday, just passed. You will be able to, instead of paying a $76,000 land tax, you'll only have to pay $2,500 a year. Obviously, and the indexation's capped. If you're buying something worth $860,000, you're only looking at a $34,000 stamp duty or an $800 annual tax. So our message is really clear on this. If this is your dream home, then we would highly encourage you to see Beg, Borrow and Steal and try and pay the one-off stamp duty. But if this is about getting you into your first property, not the property that you're going to spend the rest of your life in, it's a no-brainer that this has got to be a serious consideration for you. Yeah. The government is subsidising you once again to get into the property. This thing's going to cost $728 million over the next 4 years. That's the government helping you forego their revenue to get you into your property. So from my point of view, people can't be judged, and the government can't be judged too harshly at the moment about trying to get people into the property market. They understand the importance of it without trying to blow up the property market. The whole idea here is you don't blow up the market to get more people in. That will cause economic chaos for this country. These types of incremental ideas matter, and that's why it was the biggest news of the week in the property space for us.
And it was also a conversation that you and I had, Ben, with the Premier in the Premier's office. So we'll put a link in the show notes if you haven't actually listened to that episode. It's well worth a listen to see some of the, I think some good big picture thinking that Premier is having around property in that state. So Ben, what a big episode. We think you and I should just do a little.
Thanks for hanging around, everyone. It's a megasode.
Oh, there you go. I like what you've done there. But a little shout out to Stiggy and our crew.
Yes.
That there is a few tricks that need to go on all that episode together and bring all the moving parts together. So thank you for that. But hopefully that's been helpful on home deposits made simple, Ben. I think that's it for us. Until next week.
Knowledge is empowering, Bryce, but only if you act on it.
See you next week, folks.
Hey guys, Bryce here again. Just want to catch you before you go and let you know, if you're new to our community, there are a lot of episodes to catch up on, but it's really important that you start from the very beginning at episode number 1, because episode 1 through to 20 share all of the foundational pillars and frameworks that you need to know to get the best out of listening to this podcast. So I'd recommend that you start there, and the little tip is to maybe start on 1.5 speed. Now, for those of you that are time poor and don't have time to go back from the beginning, don't worry, we've got you covered as well, because we've created a binge guide that goes through all of the details and makes it easy for you to read and get up to speed very, very quickly. So if you go to thepropertycouch.com.au/fast track, you will be able to download that binge guide and you will be up to speed in no time. And whilst you're there, I've got a few extra goodies for you, because we have our top 5 frameworks that you'll learn on this podcast, as well as the Make Money Simple Again ebook, which will help you with the foundations of basic money management, so you'll have everything you need to succeed in building your own lifestyle design and getting the best out of this podcast. Now, just a reminder that anything that we cover on this podcast is not considered financial advice. We certainly recommend that you get your unique circumstances looked at by your individual advisor, and everything we talk about is just general in nature. But folks, I want to encourage you again to go to thepropertycouch.com.au/fast track, and you can go and get all those goodies and catch up right away.